In the world of venture capital, you regularly hear stories of incredible outsized returns. Whether it's Jason Calacanis rolling an early $25K Uber investment into over $100 million, Peter Thiel taking 10% of Facebook in 2004 for $500K, or the umpteenth tech employee getting rich off of their startup equity, these tales are recounted like urban legends. But what if you're an outsider? Maybe you don't work in tech, you have no network, no disposable income, or you're not an accredited investor. Well then, for most of the past century, you simply cannot invest in private startups by both law and circumstance. So even the idea of investing early in a unicorn startup, however unlikely for it to have that outcome, was an impossibility. But something happened in 2012 to give rise to what we now call equity crowdfunding, analogous to how companies like Kickstarter and Indiegogo popularized online crowdfunding, where anyone could chip in a few bucks to back indie projects in exchange for products or perks. Companies like Wefunder, Republic, they popularized equity crowdfunding, where just about anyone can place micro investments in companies in exchange for shares of ownership. In this video, we'll dive into a brief history of equity crowdfunding, its significance for unaccredited investors like most of you and I, and examine what the future of this space might look like. And if you stick around to the end of the video, I'll share the 4 investments I've personally made on these platforms, as well as how they're doing. To start, let's back up and look at the laws that have undergirded the world of private investments. The roots trace all the way back to the stock market crash of 1929, a period where financial markets were much less regulated than they were today. Through much of the 1920s, stock prices were soaring as many investors bought stocks on margin and made speculative trades. And as that bubble burst, over-leveraged investors were margin called, which sent stocks and banks into a further downward spiral. Following this whole mess, the Securities Act of 1933 was passed to establish a framework for protecting investors from what happened in the crash. And while the legislation was well-intentioned, it effectively created a divide between accredited and non-accredited investors and drew a line on their access to private versus public investments. So let's break that down further. In the US, basically anyone can invest in a public company. You can open a brokerage account, pick a stock, and buy and sell at your discretion. At the same time, for a company to be public, they have to adhere to rigorous standards for financial and legal disclosures. The idea is that all market participants get the same set of transparent data on which to base their investment decisions, rather than just insiders front-running trades, for example. But private companies, on the other hand, are not required to make those same disclosures, and because they aren't traded publicly, these companies are not nearly as liquid. It's a much less even and transparent playing field, which makes the investments potentially riskier for the general public. And so in an effort to protect people's money, the accredited investor designation was created. Only those who met specific income and net worth criteria could participate in these private securities. The definition of accredited investor continues to get updated, but it's generally a net worth and income hurdle. For example, for individuals to be accredited today, there's criteria like having income of over $200K for each of the past 2 years, or holding certain financial certifications such as Series 7, 65, or 82, or having a net worth of over $1 million excluding primary residences. And by the way, why do they exclude primary residences in their net worth calculation? Well, in 2008, we had the subprime mortgage crisis, so in the spirit of protecting investors, that clause was added to make accredited investor status even more stringent. You might notice a trend here, where a big crash leads to corrective legislation, which then leads to a change in the investment landscape. So now fast forward a few years to 2012, the country is still recovering from the 2008 financial crisis, and this was a period where traditional sources of capital were still constrained and unemployment was high. So lawmakers were looking for ways to stimulate the economy via small businesses. One way to do that was to unlock more sources of capital by involving the broader public and stimulating small businesses. So in 2012, the Jumpstart Our Business Startups Act, or JOBS Act for short, was passed under Obama. This basically legalized equity crowdfunding and opened the door for companies like Wefunder and AngelList to take off. Both of these companies helped lobby for the JOBS Act, and after it passed, they immediately launched the middle-end platforms to both connect investors to startups and handle the financial and administrative operations for executing the actual fundraisers. There were still strict limits though. Companies had to file extensive disclosures with the SEC and provide investors with detailed documentation about their business, financials, and risks. And all crowdfunding transactions had to be conducted through a registered broker-dealer or a funding portal registered with the SEC. This is the role that Wefunder plays, for example. It also wasn't until 2016, when Title III of the JOBS Act went into effect, that unaccredited investors could participate. And initially, the amount an unaccredited investor could invest was limited to annual limits of low thousands of dollars, depending on their income, and companies were limited to raising a maximum of $1 million of crowdfunding within a 12-month period. In 2021, the max amount a company could raise through a 12-month period was increased to $5 million, and the investment limits for investors were simplified. So today, there's no limit on how much accredited investors can invest, and the limits for non-accredited investors, they continue to get updated. So what was the impact of all these changes? You would think that with such landmark legislation that basically enables a new investment category for unaccredited investors or retail investors, that there might be some retail investor revolution backing private startups, but I think the appetite for equity crowdfunding overall has been pretty muted. It's been nothing like the retail investor mania and democratization that's been seen over the past 10 years with public market trading. So pre-COVID and pre-ZIRP, like most industries, there was some hype around equity crowdfunding and a bunch of startups emerged in this space, competing for the exact same business. But by now, in 2024, most of them have either shut their doors or pivoted their business away from unaccredited investor target audiences, including some of the early leaders like AngelList and Republic who have gone on to do different things. Wefunder is really the main OG that's still around. So what's the issue? Well, I think there's an uncomfortable truth that we have to acknowledge head first. From the perspective of an unaccredited retail investor, the fantasy of investing in private startups is that you can buy a lottery ticket into a unicorn company. And we'd all like to think that we could get a piece of a company like an early Facebook, Uber, Airbnb, etc. But the reality is that the top startups in the Valley, by and large, just don't need to resort to equity crowdfunding. If you're a hot early stage startup, you have VCs piling at your door to invest, and it just becomes a competition between investors to get the chance to invest in the first place. These companies will never think to raise from retail investors, especially at an early stage when they can instead take money from prestigious VC firms and rich and powerful individuals who can offer a lot more value through influence, network, advice, future capital, and more. So then who ends up raising on Wefunder? I'm going to make an umbrella statement here that's definitely not super fair to all the companies raising, and know that there are tons of exceptions, but most companies I see on these platforms are simply not top-tier startups, to say the least. In the worst case scenarios, they're far from it. They might be companies that couldn't raise institutional capital or are simply not doing well and are raising from retail investors as a last resort. I've even seen multiple companies with barely any runway raising money on a rolling basis only to go out of business months later. Surprisingly, there's not much quality deal flow and it's a bit of a catch-22. Quality startups aren't going to bother crowdfunding if there isn't much investor demand, and investors aren't going to bother investing if there aren't many quality companies to invest in. It is worth mentioning that over the past few years, there have been some great companies who have raised this way. These tend to be very rare, and when it does happen, you'll basically always see them as case studies in the crowdfunding platform's marketing materials. Companies like Gumroad, Replit, Mercury, Substack, and even Wefunder itself, for example. These are all great companies backed by smart capital, and they've almost all had very hyped, oversubscribed fundraisers. But these deals are few and far between, and often when they do raise, it's at a later stage when the company is already relatively large and perhaps not at an attractive valuation for the price. So where do we go from here? I think there's multiple paths opening up. One key trend is that equity crowdfunding is becoming more of a marketing and community building move rather than something done purely to raise money. For example, when Replit raised on Wefunder, you had to be a Replit user or at least have a Replit account. When Substack raised, they presented it as an opportunity for creators to own equity in the company. So it's one way to market your product and more deeply engage your existing community, especially for products that are driven by power users. In fact, Wefunder has effectively rebranded equity crowdfunding on their platform to raising community rounds. There are also lots of small businesses crowdfunding, from coffee shops, restaurants, sports teams, movies, B Corps, and other cause-driven businesses. These aren't businesses that are chasing 1,000x returns and billion-dollar exits. These are just great small businesses looking for a shot to pursue their own unique missions, and it's awesome that they can go to a platform like Wefunder and get their communities to invest in them directly. So while there's a Silicon Valley VC angle of making bucket loads of cash, not every investment is made with that intention, and sometimes you back things just because you care or just want to support a certain cause. The important thing is just that the retail investor goes in with the right expectations. For example, I met someone this year who was investing in movies on Wefunder. It was actually at a Wefunder networking event, and he was thinking that it would give him passive income streams and set him up, in his words, for financial independence. Now, is it possible that that could happen? Maybe, but is it likely? Honestly, I don't think so. And like a lot of risky investments, you should assume that they'll likely go to zero and that your money is going to be illiquid for many years. And if your financial situation can't handle that, you may need to think twice before committing. I think retail investors should also be cautious and realistic with their expectations. Are you investing because you expect a fat return, or just to support a cause or something else? And now looking ahead, I think there are a couple other trends to look out for. First off is legislation. If accredited investor requirements loosen in the future, that could unlock a lot more retail money to go around and make for bigger, faster raises. And as the cap on how much money a company can raise per year increases, perhaps more companies might place more importance on crowdfunding. For example, back when it was $1 million per year for companies, sometimes that cap was just too low to justify spending the time because it just wasn't enough money to seed the round. And ultimately, just as this sector was initially made possible by legislation, I think its future success also relies on legislation not getting in the way. And the next consideration I'll throw in is whether more established, larger trading platforms enter equity crowdfunding. For example, if Robinhood offers such a product to its millions of retail investors, that could potentially jumpstart both the supply and demand side of attracting private companies to raise and opening millions of Robinhood wallets up to invest in. Now, maybe that's a far-fetched idea right now, but as larger financial institutions roll out more and more products like stock trading, crypto, joint accounts, retirement accounts, even prediction markets, maybe they'll eventually get around to equity crowdfunding. Of course, the opportunity today probably isn't lucrative enough for them, but here's to hoping. All right, so that's, I think, all I have to say on the topic for now. If you stuck around this long and are curious, here are the 4 companies I've invested in via Wefunder and Republic. They're Gumroad, Substack, Synthesis, and Replit. And these are all very much mainstream consensus choices as far as equity crowdfunding goes. So there's not too much inventiveness in my rationale behind backing them, other than that they're all companies trying to go for big exits, run by great founders, and backed by prominent VCs. And across these 4 companies, what are my gains? Well, there have been no exits, of course, and my paper gains are less than 1% overall. Really only Replit has been marked up a little bit. So expectations-wise, I don't really expect to generate any alpha on these investments, and I don't expect any investment to become liquid, honestly, within the next 10 years. My motivation has really been to learn and follow along the building of these companies, and to that end, I think it's been pretty great. I feel excited every time these companies release features, maybe because I have a vested interest in their success. And in the case of Gumroad, for example, Sahil shares updates all the time on his philosophy behind running the business, which I find pretty insightful. On the other hand, I think it's worth mentioning that these companies also raise community rounds at pretty high valuations. The Substack one, for example, was controversial at the time, with a lot of people saying it was too overvalued and they were fleecing retail investors. But anyways, look, the entry price matters, even for great companies, and everyone needs to invest based on their own risk, appetite, and personal goals. All right, so we'll wrap it up here, and hopefully in the future, I'll be back to make another video on the topic once this space matures more. So thanks for watching. See you on the next one.